All right, welcome to session 5 of Unit 9. In this session, we're going to have a brief overview of how we go about measuring cost behavior. I like to tell my accounting students that they're familiar with accounting systems and the underlying general ledger system, which is a list of financial accounts that are charged, debits and credits. But the point is that I ask them, have you ever seen a financial account called fixed cost or a financial account called variable cost? They don't exist. So as we move into management accounting, how do we identify fixed cost and variable costs? The prior sessions have demonstrated we need to know those numbers in order to do sophisticated analyses such as cost volume profit analyses. This session we talk about how we get there, how we identify variable cost and fixed cost. This material is covered in chapter 14 of your e-textbook. Please note that we're not using all of the pages in chapter 14. The syllabus identifies which pages are relevant as well as which problems you should focus on. All right, so as a quick review, here's the total cost function that was identified in one of our very first sessions. Quite simply, the total cost function is a function of fixed cost as a constant, and then the function increases in a straight line, a slope, based on variable cost. We can now take this visual cost function and translate it into an algebraic equation we can work with. It's a very simple equation. Y, or the total cost, is equal to the intercept, or the fixed cost, plus any variable cost times the number of units, or the amount of the cost driver activity. Usually in our discussions, it's number of units. So a very simple function would be the total cost is equal to $10,000 in fixed cost plus $5 per unit. Now, in identifying the cost driver, which I said could certainly be number of units produced, it can be other things like labor hours or machine hours. How do we go about identifying the cost driver? We want to choose a cost function that starts with choosing the proper driver. Managers use activity analysis to identify the appropriate cost drivers. Here are several options we have on measuring cost functions. The first two are qualitative. They are not based on mathematical models. The latter three are quantitative in that they are based on mathematical models. However, we're going to scratch out high-low analysis and visual fit. The high-low analysis is very sophomoric, to be honest with you. A lot of data is thrown out in order to calculate a cost function based on the highest and lowest data point. We won't do that. We won't use that analysis. And visual fit is also very subjective. In the current session, we're going to discuss engineering analysis and count analysis. And then the next session number 6, we'll do least squares regression. Engineering analysis is simply analysis that measures cost behavior according to what costs should be rather than what they have been in the past. So literally, engineers such as industrial engineers would do a systematic review of materials, supplies, labor that go into producing a product, as well as support services such as purchasing, accounts receivable, information technology support that are needed to support production and sales, and the facilities needed for production and sales. In that systematic review, fixed cost and variable cost are identified. But I want to stress, it's based on what should occur, not necessarily what occurred in the past. Account analysis does make use of data that has occurred in the past. So in this simple example, Parkview Medical Center, we would have gone through the accounting system and literally pulled invoices and transactions and then classified those transactions as either fixed or variable. Uh, Obviously, some transactions could have both, some fixed amount as well as some variable amount. But in this simple example, we identified supervisor salaries and classified it as fixed. We identified hourly worker wages and their benefits, classified that as variable. Certainly, equipment rental and depreciation is fixed. We identified equipment repairs as variable because the idea is that as we produce more, machines going to break down. As they break down, we incur repairs. On the other hand, at lower production levels, not running the machines as much, less likely to incur or need equipment repairs. All right, so all of this data comes from pulling detailed transactions and subjectively classifying them as fixed or variable, possibly identifying some transactions that include both fixed and variable and separating those out. Before we move on to the final session, I want to emphasize that whatever method we use for classifying costs must pay attention both to the plausibility and the reliability of the cost function derived. Plausibility has to do with believability. So think about a purchasing department, and we might do an analysis that suggests that purchasing costs are driven by the number of purchase orders processed as well as the number of suppliers that we utilize. That seems plausible, believable. On the other hand, if we came up with a conclusion that purchasing costs are a function of the number of customers that the company has, there may be a high correlation, there may be a correlation there, but it's simply not believable. And whichever method we use to identify that relationship, whether it's an engineering analysis or account analysis or least squares regression, if it turns out to be not plausible, we simply would not use those findings. Second, the cost function derived must be reliable. That means that if we were to remeasure it, we would get the same or similar results. A cost function's estimates of cost at actual levels of activity must reliably conform with the actual cost observed. All right, in session number 6, we're going to turn to least squares regression analysis.